Welcome to the Mortgage Rate Weekly Market Update for the week of August 6, 2018. Hello, I'm John Thomas with Prime Residential Mortgage, here to give you an update. Well, last week, mortgage rates were finally able to end the week slightly lower than where they started. If you take a look at the bond chart on the screen, you can see mortgage bonds have been in this downward pattern of selling off since about middle of July. We did find a weak floor of support last week. As you can see, we were able to bounce off of that on Friday, Wednesday, moved a little bit higher on Thursday, and then on Friday we were able to rally when the jobs report came out with that big green candle. But if you look right there on the chart, we've got this giant overhead ceiling of resistance with four different resistance levels kind of together. We got the 25-day moving average, the 50-day moving average, the 100-day moving average, and a technical trading signal called a Fibonacci level at 101.988. So it's going to be very tough to break through that ceiling of resistance. We haven't, every time we've broken through over the last couple months, we broke through for a day and then we couldn't confirm it the next day and traded back below the 100-day moving average. So with that in mind, strong overhead resistance, and we do have room to move lower. If we break through that weak floor of support, about 40 basis points to go lower, we're going to recommend locking your mortgage rate, start the week. Unless we can break through that quadruple layer of resistance, just go ahead and lock your rate because it could get worse before it gets better. The risk outweighs the reward. Now, if we dig into the economic news, big report last week on Friday was the jobs report for July 2018. There were 157,000 jobs created, which was below expectations of 190,000 jobs. However, there was a net positive revision of 58,000 jobs for the previous 2 months of May and June. May was revised higher by 24,000 from 244 to 268, and June was revised higher by 35,000 from 213 to 248. Now, hobby and retail toy employment fell by 32,000 jobs, largely from the closing of Toys R Us, which dented that headline jobs number for July. So July could be a one-off with a 157 because we added 32,000 from we lost from the Toys R Us. That puts us right about where expectations would have been. So we'll have to see if August bounces back. Now, also in the jobs report, we saw the unemployment rate tick down from 4% to 3.9%, which is the lowest reading since May of 2018, and it's around the 18-year low for unemployment rate, which is unbelievable. The unemployment rate decreased because the household survey, which is used for the unemployment rate, showed 389,000 jobs created and only 105,000 new people were added to the workforce. So we saw a drop of 1% in the unemployment rate. And then the U6, or total unemployment number, dropped from 7.8 to 7.5%. That measures the total number of people unemployed and marginally employed. So all in all, on the labor market, very good report. Even though the jobs number was a miss, we can explain that, hopefully a one-off from the Toys R Us. So it looks like the labor market is doing very well. That comes after a very good GDP report of 4.1%. Now, also in the jobs report, we got the average hourly earning. It was up 0.3% from last month, but year over year remained at an average of 2.7%, which means there's basically no wage inflation in the jobs report. And having no wage inflation is bond-friendly news because inflation is the enemy of bonds. So that was good for mortgage bonds, and that helped them rally on Friday. Then we saw the Federal Reserve Open Market Committee meeting last week, and they decided not to raise the Fed funds rate. They kept it unchanged, but they said they will be gradually raising the Fed funds rate as time goes on. They have not changed their stance on that. So we could see more increases in the Fed funds rate maybe at the next meeting. Then we saw week initial jobless claims on Thursday, showed an increase of 1,000 claims to 218,000 claims. The previous week remained the same at 217. So weekly initial jobless claims remain at historically low and continue to show a very strong labor market. Employers are holding on to good employees, trying to find good employees to hire. So it's a very good labor market, and that's also reinforces that unemployment rate of 3.9%. So doing very well there. Now, if we dig into the housing news, the flood insurance bill passed the House, and then it passed the Senate last week, which gives the National Flood Insurance Program an additional 4 months of continued coverage. So they didn't fix it. They just kind of did a stopgap pass bill to cover it until for 4 more months. So for nearly 5 million homeowners and business owners, they get continued coverage for 4 months. So the bill passed 86 to 12. and it already passed the House, as we said. The reason it was only a temporary measure is because the program needs a major overhaul, as it owes more than $20 billion to the United States Treasury, and that's after receiving $16 billion bailout from Congress in 2017 to make sure claims for Hurricane Harvey were paid. So the bill extends coverage through November 30th. So this issue will be back in front of Congress very soon. So this is a hot topic, National Flood Insurance Program. If you're in the area that needs flood coverage, if you're in those states, you want the program, you want the coverage to be lower. Now, if you're in states that has no flood, middle of the country, you don't want to have your constituents pay increased taxes to support people who are in flood zones because your people don't. So it's kind of a battle. If you're in an area that needs it, you're all for it. If you're in an area that doesn't need it, you don't want to pay to support the people that are in a flood zone. So they've got to figure out some kind of fix. It just keeps getting more expensive with more claims coming from these different disasters. Then we saw the Case-Shiller 20-City Price Home Index come out for May 2018, showed an increase of 6.5% from May of 17 to May of 2018. Home prices were up 0.7% from April to May. Home prices continue to rack up gains that are 2 to 3 times that of inflation, with the rise in mortgage rates, it's starting to affect the affordability of homes in some parts of the country, so we'll have to keep an eye on that. Now, rental and housing numbers for the Census Bureau came out. U.S. Census Bureau reports over the 10 years from June 30th of 07 to June 30th of 2017, the number of renter households increased by 8.4 million to 43.4 million total, while the number of owner households increased by just 0.9 million to 76.1 million. However, the last 12 months from June 30th, 17 to June 30th, 18, the number of renter households in the United States declined by 0.1 million to 43.3, while the number of owner households increased by 1.8 million to 77.9 million. So over the last 10 years, home ownership not been a big jump. Rentership has, but over the last year, we've seen a decrease in renters and a jump in home ownership. So that means people are finally being okay with getting back out of the rental market and owning a home. They're realizing real estate is a great investment long term, and it's a way to build long-term wealth. Because if you're renting, increase in rents every year, eat up any increase in your wage, growth you might have. So if you get a raise, but your rent goes up, kind of offsets. You really can't get ahead. But if you get a 30-year fixed-rate mortgage, for the most part, you're fixing your housing paying for the next 30 years. So over time, it becomes a less and less percentage of your overall household budget, which helps you to build long-term wealth. Remember, the question is not, do you want to pay a mortgage? It's whose mortgage do you want to pay, your landlord's or yours? Now, in the local news, we got a next first-time homebuyer seminar Saturday, August 18th in Newark, Delaware, from 10 a.m. to noon at the Christiana Hilton Hotel. And then we are back in Wilmington the following Wednesday, which is August 22nd, from 6 p.m. to 8 p.m. in Wilmington, Delaware, at Independence Mall EXP Realty Office off Route 202. You can register for either one of those events. Give us a call in the office, 302-703-0727, or online, www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.